PayPal reported their Q2 earnings before the market opened, and shares are popping during the trade, up nearly 7%. In this video, we will go through not just the headline numbers of revenue, earnings, cash flows, we'll also go into the upcoming guidance for the Q3 and the full year that this company provided and raised. We'll also take a look at some key Q2 messages that they provide, take a look at some important KPIs that this company also gives us insight into, take a look at some news and settlements coming out of big tech that relates to PayPal. I'll also take a look at the transcript, and I think what is one of the most important questions that was asked by an analyst regarding competition, and more specifically Apple Pay when it comes to PayPal. And then we'll take a look at the financials, and as always, jump into the technicals. This one, you definitely want to stick around for the technical part, as we're now once again basically just trading sideways and have broken down from an uptrend. We'll see where PayPal shares are likely headed as we move ahead into the year. Hey guys, hope you're doing well out there. It's time to check in with PayPal Holdings, ticker symbol PYPL. Only a few cracks we get at this one in the year, and this is, I think, one of the most contentious stocks in the markets out there. And look, whether you're a bull or a bear on PayPal stock, let me know in the comments below what your thesis surrounding this stock really is. Year to date, you really haven't done much. You're up just fractionally. I think that even still accounts the gains we're making during the regular trade today. Over the past 1 year, you are down nearly 23%. Now, full disclosure, I do own shares in PayPal, and I am bullish on this stock. And as we go through this print, I'll try to highlight some levels or some points why this company remains an important holding for me and why I continue to be bullish on the stock. In fact, why I'm probably the most bullish on the stock than I have been over the last 9 months. Now, keep in mind that your market cap on this is close to around just $61 billion. That's for the whole company. That is important, especially when we get over to their cash flows. Now, Q2 revenues came in at $7.9 billion. That was good for 8.2% growth year over year. Did beat estimates on Wall Street by right around $80 million. So we got a top line beat right there. Now, Q2 non-GAAP EPS came in at $1.19, again, beating estimates by nearly 20 cents. That is a huge beat. That's nearly a 20% beat on what analysts on Wall Street were expecting. In fact, the high end for expectations on Wall Street by 32 analysts was $1.04. PayPal coming in with $1.19. And keep in mind, the non-GAAP EPS results for PayPal now also include the impact of stock-based compensation. So this is basically very similar to your GAAP EPS numbers as well, considering the fact that stock-based compensation impact is now included in that non-GAAP figure. Some other important lines is transaction margin dollars, basically measuring the profitability of PayPal's core business. That increased 8% up to $3.6 billion. TPV, otherwise known as total payment volume, also coming up 11%. That's both on a spot and foreign exchange basis, up to $416 billion. This basically represents the TAM over at PayPal. So the bigger the TAM gets, the bigger the addressable market gets, the more total payment volume they will likely increase, and then the more transaction margin dollars they can squeeze from that. Some other important things is payment transactions. That came up 8%, and we'll get more into their KPIs in just a second. But first, more importantly, let's take a look at the upcoming 3Q guidance. That came in at mid-single digit growth, and that's really what Wall Street is anticipating for the upcoming Q3. That's on the revenue side, expecting right around 7 to 7.5% growth. Basically call it at $8 billion flat for the upcoming Q3. Then they're also expecting non-GAAP EPS to come in at high single digit growth rates, and your GAAP EPS roughly in the range of 96 up to 98 cents a share. Now, along with quarterly guidance, this company provides full year outlook for the full year of 2024, and they once again raised full year outlook on pretty much every metric you can think. So transaction margin dollars, that's the number we looked at right over here. That was up at $3.6 billion in the most recent quarter. They're expecting full year transaction margin dollars to be higher by low to mid single digit growth. Prior guidance was for basically flat to slightly positive, maybe think 1 to 2%. Now they're maybe expecting closer to 5 or 4% growth on that transaction margin dollars. They're also expecting non-GAAP EPS to now grow in the low to mid teens. Prior guide was for mid to high single digit growth. So again, raising that non-GAAP EPS guidance on that growth rate side. Similar story on your GAAP EPS. Prior guide was for $3.64. Now that is up to $3.93 on their midpoint. So call it basically 30 cents higher on that midpoint. They're also raising free cash flow guidance for the full year up to $6 billion. Prior guide was for $5 billion. And then they're basically putting all of that into work in the form of a share buyback, which they again raised from $5 billion up to $6 billion. So basically anything that PayPal is seeing benefiting on their financials, they're passing those along to you the investor in the form of an increased share buyback. So they're generating more free cash flow and they're returning more of that to you. Another good sign for investors. And keep in mind, we just took a look at this company's full market cap, close to $61 billion. You round that basically at $60 billion flat, and you're looking at a $6 billion share repurchase for full year 2024. This company is expecting to buy back nearly 10% of their market cap in full year 2024. That is impressive. And when we get to their cash flows for the most recent quarter, we'll see they're basically on pace to do just that. Now, from their second quarter, some key messages that came out was that they're building the foundation for durable and profitable growth. That is based on the fact they posted a strong second quarter and now completed a strong first half in their results. And look, profitable growth are the two words that this company really has been singing since Alex Chriss took the helm of this company right around 9 months ago. And they're really focusing on that profitable growth, and they're at least showing it over the last 3 quarters. Branded checkout, this was their PayPal checkout, Braintree, which is part of their unbranded checkout, and then Venmo are all contributing to the highest transaction margin dollar growth rate since 2021. So this 8% growth rate is actually increasing since 2021, and once again on pace to have their highest growth rate since mid of 2021. So that's again impressive to see. They're really firing on all cylinders and all parts of their business contributing to that transaction margin dollar growth. Now they're also driving consumer momentum with monthly active account growth across both PayPal and Venmo. And I want to point this out. This has been one of the knocks on PayPal since really, I'd say mid 2022, since all of 2023, is that active accounts and the activity metrics have been declining. So since we see Q4 of 2022, that's when active accounts peaked at 435 million active accounts. And since then, throughout 2023, they were declining down to 433, 431, 428, and then to 426. That was sort of their bottom in Q4 of last year. And since then, over the last 3 quarters, you've actually seen an uptick in active accounts. So you saw it from 426 up to 427 million. And now in the most recent quarter, you came in at 429 million active accounts. And look, while sequentially you're once again on that rise, you're also flattening out your decline on a year-over-year basis. So instead of declining 2%, you then declined 1% in Q1, and now you basically were flat on a year-over-year basis in terms of your active accounts. And I think it's just a matter of time before you see once again that year-over-year uptick in active accounts. I think this is one thing that's really been a knock on this company for a long time, and they're proving and they're showing that quarter in, quarter out, they're able to grow those active accounts once again. They've already been doing that on the monthly active accounts, as that was up 3% on a year-over-year basis. So on a monthly basis, people continuing to sign up for PayPal services one way or another, and that is shown through a growth in monthly active accounts. On top of that, you're also seeing number of payment transactions still increasing year over year, quarter over quarter as well. And even more importantly, they're increasing the engagement on those existing active accounts pretty substantially, as you're up again 11% year over year. Last quarter, you were up 13%, and then Q4, you were up 14%. So sequentially is slowing down just a little bit, but they're maintaining that low teens growth rate on the transactions per active account. So I think this was a 1-2 punch that really Wall Street needed to see, was the growth in active accounts and then growth in transactions per active account. That is what PayPal is looking to deliver now. They're basically on the verge of increasing those active accounts on a year-over-year basis. Once they, I think, do that, this company is primed for upside, considering that knock on PayPal really would dissipate after that. Now they're reinvesting those cost savings into growth initiatives such as checkout. We'll talk more about their Fastlane checkout process, which they're looking to introduce in August. Omnichannel, we'll also take a look at some news stories surrounding the way PayPal can now step into Europe in terms of offline payments, and then the ads platform. I think this is another untapped area for PayPal, considering how much data they have both on their merchants and their consumers' shopping habits. They can serve those ads and really increase conversion for their merchants, which again adds to the stickiness of PayPal services. I think this is something that can far be overlooked, but anytime you provide your merchants with the ability to convert on their customers even just a little bit more, that adds to the stickiness of any PayPal service. Like we said, they raised their full year 24 guidance for basically all metrics, and now they're focusing on best-in-class checkout experience to optimize those conversions. They also partner up with Meta and DoorDash with Fastlane, then opening up to US customers and US merchants in August, so extremely soon. And look, they're already seeing good results from A/B testing on those Fastlane services, now achieving 80% conversion for returning users versus the industry average of guest checkout conversion, nearly 50%. So basically, anytime you're maybe looking to buy something on a website or on a service where you are checking out as a guest and maybe don't have an account, that is really important for any merchant really doing business. The more they can convert those guest checkouts by close to 80% instead of 50%, you're driving more business into those merchants. And that's, again, one of the reasons why any merchant would choose to prefer PayPal over any existing checkout experience if they can simply increase that conversion. Similarly, on their branded checkout flows, this is basically paying through the PayPal button. Tests showing that they've redesigned that payment and lift conversion by nearly 75 to 110 basis points. So even if you convert your customers by just 1% more on large enterprises like a DoorDash, that's billions of dollars that you additionally flow into a business like DoorDash, adding significant amounts of dollars to their bottom line. And just, I think, one of the more reasons why a company like DoorDash or a company like Meta would choose to continue to partner with PayPal, simply because they can convert their customers by even a percent or two more. That is really important, especially for large enterprises. For small and medium businesses, they're continuing to build momentum through PayPal Complete Payments, and they're seeing total transaction payment volume up 40% through the first half. And then for the consumers, for people like you and me using Venmo, using PayPal, they're enhancing the app with more offers. They're also driving Venmo monetization. I think this is an important fact, that Venmo is still relatively under monetized from at least a consumer point of view, and they're looking to drive more monetization through that. I think that is a good thing. And then lastly, they're meeting consumer demands for in-person payments. So we know PayPal is sort of the online payments platform or the online payments channel. Now they're looking to expand into more in-person payments. And I think that relates to our story of an antitrust settlement that passed in the EU regarding Apple's antitrust into mobile payments technology. So this was an investigation hosted by the EU that concluded the Apple's restriction of its NFC technology, which is really that tap to pay or touchless payment service that Apple limits to their own devices and their own apps, is constituting as an abuse of market power. And so as a result, Apple has agreed to allow rival mobile wallets like PayPal wallets to access its NFC technologies over the next decade. I think this is a really important settlement that is certainly not just helpful for PayPal, but also helpful for PayPal's competitors and rivals. But I think a rising tide does lift all boats. And so while PayPal's competitors also now have access to Apple's NFC technology, I think PayPal will be one of the biggest beneficiaries of this, simply because they have a bigger market access. They can now access Apple's extensive user base and integrate PayPal services directly into the NFC technology, significantly expanding PayPal's reach. And this is specifically relevant in EU and the European market, but I think at some point maybe could come even to the US and North America. That would be a significant impact for PayPal, simply because they wouldn't be locked out of Apple's NFC technology, really locked out of Apple's walled garden. And so I think this breaks down one of the other bigger concerns with PayPal stock is competition regarding specifically Apple Pay. And on the conference call, Dan Dolev of Mizuho Securities asked a great question, in my opinion, specifically regarding Apple Pay. He asked, Alex, a little bit about the competitive positioning regarding Apple Pay. Obviously, you have a really strong branded checkout, but there have been some worries in the past. Can you maybe contextualize a little bit where you are and what you are doing to beat them? So that was a pretty direct question, pretty great question, I'd say, specifically asked regarding Apple Pay. So Alex basically said, first of all, there is a massive multi-trillion-dollar opportunity. That's their TAM, and it's not a zero-sum game. So they've had competitors in the past, and they'll continue to have competitors in the future. But there's basically a branded experience that PayPal differentiates themselves through, and they'll continue to do that. And so they still remain the number one branded experience across all platforms and devices. Specifically for desktop and web, they're still nearly 40 to 50% of all global checkout, and they really don't see any market share being taken away over the past 4 years. And he mentioned that again, despite the competition, there has been no market share lost from PayPal, specifically when it comes to desktop and web. And then even across browsers, there's no difference in their selection rate across different browsers. And then when it comes to answering the second part of the question, what they're doing to beat Apple Pay, or really at least compete with Apple Pay, they've talked about a new branded checkout experience, basically changing the way a customer would check out using the PayPal button, also changing it on the merchant side. They also have that Fastlane product coming for guest checkout experience. They've begun to roll out ads, continue to invest in profiles, helping merchants on the end-to-end side, and then also looking for ubiquity, flexibility, and a rewarding experience. They are the most ubiquitous, and they have a nearly 80% acceptance rate in the developed world with large and growing customer base. So I think they continue to bring forward some pretty good innovations where they're increasing the experience that a guest or a customer really would experience on that PayPal service, but also how a merchant deals with it as well. And I think that is some things that can at least compete with Apple Pay even in a growing market environment. Now, those were some intangibles that I think PayPal will continue to execute on, and we really just have to wait and see how their innovation really is monetized and how impactful it is for their customers and merchants. What we can know from a tangible perspective is how well this company is doing financially. We take a look at their balance sheet from a cash and equivalents perspective. They have roughly, call it $14 billion in cash and short-term investments. That's from the most recent June 30th quarter, and then 6 months ago, basically roughly close to $14 billion as well. In terms of long-term debt, sitting at right around $9.7 billion in long-term debt. So they have more cash than debt on hand, and in fact they have nearly more total current assets than they have total liabilities altogether. So from a balance sheet perspective, this company is looking extremely healthy. One of the reasons why I think I remain extremely confident in this business being able to turn itself around from those KPIs, simply because they have the cash on hand to go through really any difficult times and continue to invest in themselves through innovation and marketing and sales. Now, from that revenue side, we saw $7.9 billion in net revenues, growth of 8% year over year. Your transaction expense really comes up in line with your net revenue. So this expense sort of grows as your net revenues grows. It's your non-transaction expense that this company really controlled extremely well. Your customer and support actually ticking down year over year. Your sales and marketing also basically ticking down year over year. They did say that they're deferring some of the sales and marketing to the second half of the year. Basically, they were focusing on the innovations and the tech and R&D in the first half. And then as they go to market with that, they really want to show the world what they have come up with in the second half. So you can probably expect this sales and marketing spend to tick up as we head into Q3 and Q4. Tech R&D also coming down year over year. G&A expense coming up year over year. That's something I actually wouldn't want to see too much, but it's not an overly extensive spend on G&A. And so your total operating expenses come in at $6.56 billion, higher by right around $400 million compared to same time last year. And so you added on roughly $200 million on your operating income, which now sits at $1.3 billion. We pay some income taxes and we get to a bottom line profitability number of right around $1.1 billion. So that is impressive to see this company really on that call it $1.1 billion net income run rate over the last 2 quarters. From that shares outstanding, you also see those ticking down both on a diluted and basic shares outstanding. That is due to their buyback, significant buyback in place when we get to the cash flows. Now, we have that $1.1 billion number in net income. We get to add back some depreciation. We get to add back actually $300 million in stock-based compensation, which, notice, on higher net income compared to last year, the stock-based compensation is actually lower on a year-over-year basis. And despite the share price actually being substantially lower over the past 1 year, this company is actually handing out less stock-based compensation instead of more. So the fact that they're focusing so much on keeping SBC in check, I think that is a sign of a well-run company, despite new management coming in. And really, they could have handed themselves quite a bit in stock-based compensation, but they're looking to keep that in check. That is something I like to see. Now, $1.5 billion in operating cash flows, that's really the run rate we've been as over the last 6 months. We're at nearly $3.5 billion in those operating cash flows, significant improvement from a year ago as well. And now we don't have a ton of capex at just around $157 million, bringing our free cash flow close to $1.4 billion. And they're using all of that and a little bit more in the form of a buyback that you see right here, $1.5 billion in purchase of treasury stock at the same rate they've been over the past 2 quarters, with nearly a $3 billion buyback. And they're really on pace to complete that $6 billion share buyback for the full year of 2024. So despite having nearly just a $60 billion market cap, they're buying back close to $6 billion for the full year in 2024. And as a shareholder, that just increases your earnings potential as the company takes shares off the market, especially at a very discounted valuation. I think this is the best use of their cash at this time. Certainly, I wouldn't want them to pay a dividend when they can continue to buy back their own shares at a relatively undervalued price, at least in my opinion. Now, as we saw from the financials and fundamentals, this company is doing pretty fantastic and really maybe even signaling a buy at this point. But if there is a sell signal, that would be from its technical chart, as this company really had been in a downtrend throughout 2023 and especially at the end of 2022, and then had broken out from that in the form of higher highs and higher lows. But now you're once again in this downtrend of lower highs and lower lows. Really, that's over the past, call it 3 months since April. And I'll remove some lines to just make this a bit clearer. But you are once again making a higher and then a lower high, and then you've now just confirmed a lower high once again, and you're confirming that with lower lows along the way. So certainly from a technical perspective, if you are in shares of PayPal and you want to sell, this really is your point to sell, considering you are getting rejected at this top end close to $65, and you're likely heading down to $55, $56 a share. So from a technical perspective, you likely come in here, fill this gap, and likely move lower in the subsequent few days. But what you do have is a certain level of support right here, right at $60 a share. Basically, call it, we've been supported at that level before. We've also been rejected from that level in the past as well. So at the $60 level, that's probably an area where this company can find some support. And then what you really want to see is a breakout higher above this $68 level. That was our previous set of highs. If shares of PayPal can come in here, go higher than 68, I think that's when you confirm a breakout from this downtrend once again, and probably continue to move higher. But until that happens, I think this company can certainly be trading in a sideways consolidation pattern, really between $60 up to, call it, nearly $67 a share. That is where I expect this one to continue to vibrate over the next couple of quarters. Really, if you get a breakout above 67, I think that's your move for PayPal to fill this gap in from, call it, 5 or 6 earnings ago. And then if PayPal comes in here and breaks the $60 level, I think you're probably headed back south of, call it, $55 once again. So those are your support and resistance levels from, I think, PayPal's perspective, at least from a long-term investor perspective as well. I would actually want PayPal to continue to trade sideways here and basically allow them to continue to buy back those shares at a relatively cheap valuation. And certainly if you are bullish on PayPal over the next few years, you would want the stock to trade sideways, at least for the remainder of the year, so that PayPal can continue that $6 billion buyback for the full year at, again, at just a 14 times an earnings multiple. That was my take on shares of PayPal. One, I think that's continuing to prove out that the turnaround really is here. Alex Chriss really has been at the helm of this company over the last 3 quarters, and he's done everything he can to continue to right-size this ship. I think from a technical perspective, this one still doesn't look great and probably still isn't a buy simply from a technical perspective, but fundamentally speaking, you have everything trending in the right direction. You even have active accounts once again churning higher on a sequential basis over the last 3 quarters. That was my take on shares of PayPal. Let me know your thoughts on this one in the comment section below, whether you are bullish or you disagree with my thesis and you are bearish on this one. I would love to hear from you in the comment section below. As always, thanks so much for listening. We'll check back with PayPal in basically 3 months. Until then, take care, and I'll see you guys in the next video.